the economic product or service of insurance. And we have a little bit of a puzzle to solve of why is insurance a product? I mean, or a service? Because the hope with insurance is that you're paying for something that you actually hope that you don't have to use. And we'll define what it is in a second a little bit more precisely, but I want you to think about that for a minute. That when you get car insurance, what that is protecting for is you pay a premium basically so that if you hurt or someone else to whatever extent or damage their property, that you can cover that. And you can have insurance to cover yourself and your own car. You can have life insurance that if you die after paying into a life insurance program, that your family, your beneficiaries get a payout of money to take care of things. You can get insurance for being a renter. You can get insurance that covers your house for things that happen like a flood or a fire. You can get insurance for things like theft. If somebody steals something, that you get the money paid back. So there's insurance on all kinds of different things. But the kind of odd thing about insurance is that you kind of hope that you don't have to use it, right? Just because somebody gets car insurance, it doesn't mean that they actually hope that they will get in a car accident. In fact, just the opposite. So how does risk play into this? And we'll look at that as well, and how insurance works. Because a lot of people actually don't understand insurance. They think that basically insurance is just a company that exists to pay money given certain parameters. It's really not that. But insurance can actually be a very effective tool if you understand what it is. Another kind of little puzzle that we have to solve is why insurance companies are the ones that have the funny commercials. This is one I like from Geico. And I like that. I like the Geico commercials, but they don't really have, it tells you about the product a little bit, but it doesn't, the funny part doesn't really have much to do with it. This is kind of, I think, one of the original kind of funny Geico commercials about, I think this is one of the caveman ones. So the caveman gets offended. And he's in a couple other ones. There's a series of the caveman ones. There's one where he's going through an airport and he sees a picture of himself on the wall saying it's so easy, a caveman can do it. But what is insurance? So let's talk about what insurance is. So the goal is so that after hear this, you know what insurance is to the point where you could explain it to someone else. So if you don't know what insurance is today, that's fine. That's what the point is. But hopefully you'll be able to understand it and explain it to other people now. So insurance companies deal with inherent and inescapable risks. Those adjectives that I put there, inherent and inescapable, are important. Okay. Risk. So in life, there are risks. We have to deal with the fact that there are risks in life that we may or may not actually encounter. There's always a risk, but there's not always the reality that that risk will culminate into an actual reality. So, for example, in like a negative way, there are some people who are going to get cancer and there are some people who aren't. That's just part of being human. There's the risk that some people are going to get cancer and that some people aren't. Some people are going to get car accidents. I'm sure there are some people also who have lived their whole lives and never been in a car accident. Now, do they both need insurance? That's kind of the interesting thing here. There's also risks of natural disasters. California, our flood risk is not as high as fire or earthquake, right? But even earthquakes are pretty seldom out here. Whereas in Texas or Alabama or, the kind of Midwest, tornadoes have a season. There's a regular tornado season. East Coast, Florida, there's a hurricane season. And that's part of the risk of living there. You're more likely to have a hurricane on the East Coast or in Florida than you are in California. So there's a different type of risk there. And so life comes with inescapable risks that you can get sick, people die, people get hurt, people get injured. Most people will not have their house burned down in a fire, but a significant amount of people will. Most people will not have their house robbed, but a significant amount of people will. Most people will not have their dog bite someone and injure them at their own house, but some people will. And so life comes with all these risks, and we have to kind of navigate that in our own life. And we all have actually our own levels of risk as well, levels of where we're comfortable with risk versus uncomfortable with risk. And that changes based on age and life situation and tolerance for risk and all sorts of different things. So, for example, risks for older people may not be the risks for you. And so only individuals, maybe small families, can calculate their own risk tolerance, risk aversion, and then their own needs for insurance. So what does insurance do about this? Because insurance doesn't take and eliminate risk out of the world. Insurance doesn't cure cancer. Insurance doesn't stop houses from getting burned down necessarily. It doesn't stop car accidents from happening. It doesn't stop people from being out of shape or smoking or whatever. So what is the service that insurance provides? And the goal for insurance is that it transfers and reduces risk. So it transfers and reduces risk. So here's how an insurance company works. So here's a sentence here. That an insurance company, in exchange for a premium, money, exchange for a premium paid, make sure that's clear, by a policyholder assumes the risk of compensating for losses. So basically, what this means is you sign up for insurance, a certain type of insurance policy. Let's say I have fire insurance for my house. Now, sometimes insurance is grouped together, but let's just keep it simple. Let's say that I want fire insurance for my house. Now, what I'm going to do is I'm going to work with this insurance company that they are going to charge me a certain amount per month per year, of how much am I going to pay for insurance for my house every year. Okay. Now I'm going to keep paying into the system. I'm going to send them a little bit of money each month. And what happens is if my house burns down or gets damaged from a fire, which I hope it never does, the insurance company will pay for the repair or hopefully replacement of my house. Now, how's an insurance company doing that? Well, they're doing that because they have multiple people paying into the system, and the insurance company works off the great probability that not everyone is going to have the same problems at the same time. So, for example, if I'm paying for fire insurance on my house, they're assuming that if my house burns down, they'll pay off my house and they can afford to do that, because that doesn't mean that everybody who holds an insurance policy with them, that their houses will all burn down at the same time. They have to pay out for them all. But sometimes it does happen, right? We have fires in California, but that's why fire insurance in California would be more costly, because the risk is greater. What am I getting? Now, let's say I never have to use fire insurance. My house, I go my whole life and my house never burns down. Did the insurance company scam me, or did I still get something out of it? Because I still had to pay the monthly, premium or yearly premium for my insurance. So was it a big waste of money? Well, in one sense, it could be yes. But the fact is, I don't know the future. And I can't assume that my house is impervious to being burned down. And so even if you never use insurance, what it actually is selling to people is the kind of peace of mind in knowing that they will cover that type of event. So that's what people are actually paying for, as well as the real coverage in case of there actually being a loss, that they will be compensated for it. Now, car insurance, why people have car insurance, a lot of times people get car insurance backwards. Car insurance is actually not inherently to protect you, your person, or your property, your car. Why it has been required for people legally to have car insurance in order to drive, even though some people don't, is because you may hurt or damage someone else's person or property and may not be able to pay for it. Therefore, you may need an insurance company to step in and pay for it. So that's why it's been legally required for people to have car insurance, not so they can just cover themselves if something happens to their stuff or their person, but so that they can cover in case they do something to someone else. And so the insurance company, what do they get out of this? Well, they make the money from the premiums, but they also assume the risk of paying out when there are those type of events. Now, here's the thing. If I'm paying for fire insurance for my home and I get cancer, can I demand on the basis of ethics and justice, can I demand that the premiums I've been paying for fire insurance be transferred to cover me for cancer treatment? And the answer in general is no. Because unless there was some sort of hybrid, type of thing, but that's not really what's going on. But if I was just paying for one type of insurance, it doesn't cover me for everything else. Right? So that's why insurance does and has to look at what are called sometimes negatively pre-existing conditions. A pre-existing condition means, look, if somebody has a history of heart disease, for example, and they are signing up for health coverage, the insurance company knows that that individual, as nice as that individual may be, that they are at a greater risk of health issues that would require the payout of insurance. And there are some things that people can control. There's some things people can't. There's like smoking or getting regular exercise or stuff like that. And then there's things that people that are genetic or that people aren't their fault, that things that happen to them. Like an earthquake, it's nobody's fault. It just, pun intended, I guess. But it's nobody's fault, but it happens. We could choose to live somewhere else, but we choose to live in California. And we assume the risk that an earthquake may be destructive to our persons and property. But we choose to live here. And so we kind of assume that risk. So that way, that getting earthquake insurance in California would be very costly. And some insurance companies in California, I'm sure, won't do it because they know that the risk is so much greater here than somewhere else. So insurance companies also seek to reduce risk. They look at generalities of a lot of people because a lot of people, when you look at generalities, it's a lot easier to see patterns. Everybody wants to go to the individual. Well, I know someone who's not like that. But when you look at people in general terms and you get statistical data over time, like, for example, what is the age of the average American that people will live to? Now, for individuals, you may know somebody who's died at a very young age. But on average, Americans are living into, I think, their 70s and 80s. So insurance companies can look at those generalities and make judgments from there. Now, we may also know somebody who smoked and never got cancer. We may know somebody who got lung cancer and never smoked. But we also know that in general, there is a pretty strong positive connection between smoking cigarettes and lung cancer and other type of health issues. And so insurance companies know that too. So they either charge people more or they don't cover them if they smoke. Right? We also know there are some people who never exercise and they seem to be healthy. And there are people who exercise all the time and sometimes they get sick. But we also know that there's a general connection between exercise and positive health outcomes. Insurance companies look at that. We also know you guys may be very responsible drivers, but the truth is, people under 25 are much more likely, statistically, to get in a car accident and die in a car accident. Most teenagers, that's not going to happen to. However, the greatest probability in terms of an age group are those 16 to 25. And especially males. It's not to say anything, it's just against anybody. That's just to observe a trend and a pattern. And therefore, insurance companies charge higher premiums for males under 25 relative to females. Insurance companies also know that older people are more likely to need to go to the doctor more, that will have more negative health outcomes, will have more health issues. And so they will usually, unless they've had insurance for a long time, pay more for insurance. So insurance companies seek to mitigate risk. That's why you have insurance companies car insurance companies trying to encourage you to be a safe driver. That's why they also have things that bonuses and things within certain insurance programs that encourage safe driving. Like they'll give you some money back if you have, a certain amount of time without an accident or stuff like that. There are also requirements insurance companies may make of people. For example, to have fire insurance, sometimes you have to clear a certain amount of brush around your yard. The insurance company is not going to come and do it for you, but they say we won't continue to cover you if you let this brush continue to grow up around your yard. So the insurance company is putting an incentive and some pressure on people to mitigate their own risk. Some insurance companies give you deals and benefits in health insurance and for gym memberships and things like that, because they know that using those things is connected with better health outcomes. So there are these different levels of risk that they observe in other people. For example, who is more likely statistically to die? Let's think of life insurance for a moment. An 80-year-old or a 20-year-old? An 80-year-old or a 20-year-old? Well, both of them are subject to the reality of death. 20-year-olds die. I just talked about car accidents. 20-year-olds, unfortunately, sometimes get terrible diseases and die, or, there are freak accidents that happen. Old people die too, but on average, which group, if we looked at 20-year-olds in the United States and 80-year-olds in the United States, which group would have more people dying more often person to person, and it would be the group with 80-year-olds. And so, looking at that generality, insurance companies can figure out how to kind of manage that risk. Now, here's kind of an interesting thing. We talked about inherent and inescapable risks. Excuse me. I was looking at that L. Now, here's kind of a riddle, a little puzzle. Is death, think about life insurance, is death an expected or an unexpected catastrophe? Is death an expected or an unexpected catastrophe? One of the sure things of life is that you're going to die. You have to square with that. But it's guaranteed. So the question is, it should be expected. Then if it's something that is 100% expected, then why would we have life insurance if we know that death is going to happen? What company would ever pay for life insurance? Because we know people die. The interesting thing with life insurance is that death is inevitable, but the risk is knowing when and how somebody is going to die, right? The death of a 30-year-old man with a young family, kids and things like that, is different than somebody who's 97, right? There's probably a different life situation there. So death is going to happen. However, there's risk involved with the time. So it's predictable in that it's going to happen, but unpredictable as to when, where, how. And then, but if every person knew they were going to die at 70 with no exceptions, there'd be no need for life insurance. So the insurance company takes on risk for a price. As I said, the average death rate of millions of people is more predictable than one individual. So we looked at the life expectancy, what that is. And so that's the product or the service that insurance provides, is that paying a premium for a service that you hope you never use is for hoping that if you ever did have to do this, use it, that you would be covered in case of a loss.